Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about Forex risk management for absolute beginners. Okay, so this class is actually for traders who are just getting started and who have heard from the professionals that risk management is very, very important, but they haven't learned exactly how to apply proper risk management. I'm talking about traders who barely know how to place a trade. Okay, so not only don't they know the importance of risk management in a practical term, but they also don't even know how to practice it. And that's why we're going to be covering today's topic. Okay, so again, there are going to be tips and tricks in today's class which are going to be beneficial for not just only beginners, but also traders who have been seasoned in trading. A couple of processes that are going to make it much easier for them to practice proper risk and money management. So without wasting any more of your precious time, let's dive right into it, okay? So first things first, what in the world is risk management? Okay? We talk about risk management a lot. You would hear a lot of professional traders telling you that risk management is very, very important, along with psychology and having an edge over the markets and all of that. But what exactly is risk management? Okay, so risk management, basically, as the phrase implies, is the act of managing risk. Because when you are getting involved with anything in the financial markets, trading related, that is in this particular example, you are exposing yourself to risk. And the reason there is risk in the market is because there is uncertainty. It's not as if when you engage in the market or speculations in the market that what you are trying to what the decisions that you're going to be making in the market is going to be 100% backed by certainty. Okay, you are involved in a probabilistic environment, and so you have to act accordingly in order to protect yourself. So in the basic terms, risk management is just the series of processes the techniques that you put in place to protect your capital in the market, so that you don't get a sucker punch or a knockout punch by some unforeseen incident that happens in the market. Okay? So, put simply, risk management is what you do or the processes you put in place that is going to make sure you live to trade another day, even if you take a series of losses. Okay? And also, not only on the losing part, because some people can be actually lucky in the market and be profitable, and that could get to their head. And so instead of being kind of being cautious, they get overconfident and think that everything they touch is going to turn into profits. And so they get overconfident and start taking excessive risk in the market. In that situation also, you need to be cautious by practicing proper risk management so that overconfidence doesn't cost you. Okay? So, moving on. And one of the reasons why risk management is very important in trading is because when you're, just like I told you just moments ago, when you're engaging with the market in the act of speculation, because basically, if you're trading in the forex markets or any other financial markets, trying to profit from the short-term highs and fluctuation in prices of any instrument you're trading, you're basically speculating in the markets. Okay, one of the reasons why practicing proper risk management, especially in speculation, is very important is because the market is a probabilistic environment where there are no certainties. What I mean by there are no certainties is, in the short term, whether you have a trading strategy or methodology that gives you an edge over the market, in the short term, that trading methodology is going to get affected by variance. What I mean by variance is, you might get outcomes that are not going to be favorable to you in the short term. So let's say you have a trading strategy that has a win rate of, like, let's say, for example, 50%. It's almost like a coin flip in this case. When you're right, you make 50%. When you're right, you make 2 times what you're risking with a 1:2 risk to reward ratio. So let me just quickly write that down. So let's say the strategy has a 50% win rate, okay, with a 1:2 risk to reward ratio. And if you've been attending these classes, these IT Forex classes, you'd know that I've been saying this not once, not twice, countless times, that when you're trading with any trading strategy, whatever trading strategy it is that you're using, you don't want to be judging the performance of your trading methodology or your trading strategy or your trading approach based on the outcome of 1, 2, 3, or even 4 trades, for example, or 10 trades. Ideally, you want to be assessing the performance of your trading strategy, ideally with nothing less than 100 trades taken. Because if your strategy truly has an edge in the market, then that edge is only going to manifest or show itself when you've taken a large sample of trades. Okay? And 5 trades or 10 trades are really not going to cut it. Because in the short term, you might get hit by variance. What I mean by variance is, even though your trading strategy might have a win rate of 50%, what naturally as humans, what we would want to see, or what would want to see, okay, is one winning trade followed by a losing trade, followed by a winning trade, followed by a losing trade, and so on, alternating like this. But this is not how the market is. This is not how the market works. You might have a trading strategy that has a 50% win rate, but in the short term, you could have a winning trade, followed by a losing trade, then a losing trade, then a losing trade, then another losing trade, and maybe a win and a loss and a loss, and it's going to be all over the place. The distribution between the wins and losses within any sample size of trades that you take is going to be random. And this is one of the things that traders find, especially inexperienced traders, they find it very, very difficult to make peace with. Because they assume that if they have a trading strategy that has a particular win rate, for example, the outcome of the trades should reflect that. But in the short term, that's not how it works. And this does not mean that if the outcome of the trades are like this, you're not going to make money in the long run. Absolutely not. And that's why you want to assess the performance of your trading strategy after taking a large number of trades. Because if, for example, you take a losing trade, followed by a losing trade, and another losing trade, and then you start to doubt your trading strategy's performance. And let's say when you were taking these losses, you were risking 1% of your trading account's capital. And all these losses that you were taking, you were risking 1% of your trading account's capital. So for these 3 losses, you were down 3%. But then you got emotional. Because let's say, for example, you were trading with money you couldn't afford to lose. Let's say maybe it's your tuition or your rent money or your kids' rent money or something. Money you couldn't afford to lose. And so when you saw the next setup by your trading strategy, the signal that your trading strategy was signaling to you to take the next trade setup, you got scared. Because in your mind, the calculation was, if I was to take a loss now, it's going to be a big problem for me. Because I might be losing more than I can afford to lose. And so instead of continuing to risk that 1% like your trading strategies rules tell you to, you get emotional and then you cut your risk down to maybe 0.25%. Because you've convinced yourself that you kind of know what the future holds. And so the outcome of this particular trade that your strategy is signaling to you is going to be a loss. Only for you to take that trade, risking 1 to make, let's say 3 for this particular example, okay? And that trade ends up being a winner. Now, the problem with this is that because you are risking only 0.25% to make 3 times what you're risking, the profit you would make from that trade would have been only 0.75%. This would not be enough to make up for the losses you had. While if only you had stuck to the rules of your trading strategy and continued to risk that 1%, if it was a winning trade, you were risking 1 to make 3. Since you were risking 1% to make 3 times what you were risking, you would have made a profit of 3%, which would have covered for all of these previous losses that you had, if you had just stuck to the rules of your trading strategy. But you didn't, because you got emotional. And this is one of the reasons why, once you've backtested your trading strategy, you've forward-tested it, you've done all of the rigorous tests, and you've seen that trading strategy has an edge in the market, you have no business, after creating your trading plan, to go about changing things in the moment. Maybe because the last couple of trades you took were losing trades, you now start tweaking the risk per trade that you are trading with, or the risk to reward ratio of the strategy. Or you have no business doing that. Once you've done the testing and you've created your trading plan, you simply just execute what the strategy tells you to do, regardless of the outcome of the previous trades you took. Whether the last 3 trades or 10 trades were all losing trades, you still trade according to the plan. You do not deviate. Okay, so this quick example that I just gave you was to make you understand why it is important to do proper risk management from a psychological standpoint, and why if you don't do practice proper risk management, then that could affect your trading performance altogether. Because if you get emotional and start maybe revenge trading, or you get fearful and you start cutting down your risk per trade, and you'd affect your trading results, and you will just be all over the place. Okay, so now that you know and you understand the importance of risk management, how do you practice this, in a practical manner? And for that, this is where we come to placing trades. So for this particular example, okay, the trading account that we're trading with, we're using for this example, is a $100,000 account. Okay, now assuming you wanted to place a trade here based on your trading strategy. Let's say you're simply trading a very simple mechanical break and retest trading strategy. So once price is making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, you just simply wait for price to make a breakout. When it retests the area and you see signs of shorting, you know candlesticks that are telling you that there's bearish momentum in the market, you take a short trade, place your stop loss above the highs, and aim for maybe 1:3 risk to reward ratio. Simple as that, nothing complicated. Okay, now the thing is, if you're trading with this particular account that I'm showing you in this example, this is the account that you're trading with, for example. If you're trading with this account and you're risking you according to your trading plan, you're supposed to risk 1% of your trading account's capital on each trade you take. And let's say this, hypothetically, this happens to be a trade setup following your trading strategies rules. Okay, now if you want to place the trade, and you just right click on the charts like we normally do, and then go to new order. The problem that you'd notice is that when you want to place the trade now, let's say you're placing the trade, at this price, is a sell stop pending order. Okay, this is just an example. Let's say you want to place the sell stop pending order at 1.1380. That's the price that you want to enter the trade at. Okay, so let's say it's a sell stop pending order at the price 1.1380. There's been an update to MT5. Okay, it looks beautiful now. So okay, 1.1380. And just for example purposes, let's say you're trading with one standard lot, because if you just install MetaTrader, most of the times that's going to be the default lot size that you're going to see. Lot size in MetaTrader, you see them saying it's volume. Okay, it doesn't make any difference. That's just what your lot size would be for the trade. Okay, now let's say your stop loss was supposed to be placed somewhere around here. Let's say somewhere around above this high, and that is going to be 1.1450. That's the price level, 1.1450. And your take profit is 3 times what we're risking on this trade. Okay, so for now your take profit would be around 631 points away from this. So just to make it easy, let's just place this sell stop pending order. Let's see, this is the stop loss and this is the levels. So let's just place it here. Okay, good. So we've placed the sell stop pending order. Now I'm going to modify it so that we'll properly place the profit targets. Okay, so let's see, for the profit target, let's see, we want it to be around 633 times. Let's say you're trading with a simple 1:2 risk to reward ratio strategy. So 633 points times 2, 1,266. So just to make it easy, let me just click on modify. I'm going to drag it so that we'll have it where we want it to be. Okay, so this is 14 points. We want it to be around 1,400 points, if I'm not mistaken. Okay, yep, agree to the license terms and conditions. So how many points is this? 700 points. So let's say we want it to be at 1,400 points, the profit target. So 1,400 points. 1,400 points. Exactly. This is how we want it to be. So we're risking, when I hover my mouse's cursor here, you'd see we're risking $700, aiming for a profit which is 2 times what we're risking, which in this case is $1,400. But the problem is, $700 is not actually 1% of this $100,000 account. Okay, so if you go on to keep trading like this, you'd actually be risking much less than what you would have been supposed to be risking. And if, for example, you decide, okay, since this is just the problem, I know what I'm going to do. I'm just going to double my lot size. I'm just walking you through the mindset of a beginner that doesn't know any better. Okay, so let's say this beginner thinks, okay, for me to risk $1,000, since I'm using one standard lot and it's risking $700 instead of the 1,000 which I want to risk, which is 1% of this account starting balance, let me trade with a lot size which is 2 and place the same trade. So in this case, let me just quickly bring it up. And so the entry price, because we are placing the sell stop pending order, let's say 2 standard lots, the entry price will be at 1.1380. Okay, and then the stop loss, like we had, is going to be at 1.1450, and then the profit target is going to be at 1.1240, and so we'll place sell to place the pending order. Now, for us to see how much we're risking on this second trade, we'll need to either move the stop loss of the first one just to have a clearer view of the second one, okay, or delete it if need be. Now, when I hover my mouse's cursor here over the second trade that we placed, the stop loss of the second trade that we placed, you see that we're risking 1,004, and so this is a problem. So for us to risk exactly $1,000 on this trade, which is 1% of this trade's starting balance, account starting balance, then we need to calculate the position size. And for that, you either need to know, the formula for your margin and your lot size, and it's a headache. And so that's not, and if you notice with these classes, I usually show you how to do things simply in a way that it's not going to bog you down. And so for that, just simply use a tool. We've done a class about this tool in the past. It's a position size calculator known, which is free for download from nforex.com. Just type nforex position size calculator into Google, download, and it's going to give you the download. Going to give you a link to the download page. Just go there and download it. Okay. So in this case, I'm going to go on Navigator because I've already installed it, downloaded it, and everything. This is the position sizer EE. The use of this tool is that it's going to help us calculate the lot size automatically. We don't need to know the formulas or do any hard mathematics or anything like that to be able to trade, which is something, we are not mathematicians, we're just traders. So basically, once you've downloaded, there are videos on the website, on the page that I told you to go to. There are videos which will show you step by step everything, how to download and install it. But once you've done that, just drag and drop it on your chart and then just click OK. This is what it's going to look. This is what your chart is going to end up looking like. Okay. So let me quickly close this and move this up a little. And here, you see, this is the tool. So since we are placing a sell stop pending order, all we need to do here is just to click on here from instant to pending, because the order we are placing is a sell stop pending order. Okay, and in this case, we want to be risking 1% of our trading account starting balance. So where it says risk here, you're just going to type 1. And here, where do you want to enter the trade? Let's say we want to enter it at remember the price that we said we would enter before, 1.1380. And then we said our stop loss would be above this area, so we'll type our stop loss here, 1.1450. Okay, and then our profit target, we said we want it to be 2 times what we're risking. You see how I had to manually, see how many points the trade I'm placing is, how, I had to place the order, then modify it, then drag and drop. You don't need to do all of that if you're using this position sizer. All you need to do is your TP. What is the risk to reward ratio of your strategy that you're using? Is it a 1:2? Yes. So you're risking 1 to make 2? Yes. Now in this field, you just type 2 and type enter. And once you've done this, click on your TP and it's automatically going to place your take profit for you. You see, it has done this. So if you want this to be locked so that every time we place a trade, it's going to be exactly 2 times what we are risking, then this is how you're going to do it. And you see, it's showing you where your take profit is going to be. Now we've done all of the calculation. The position size that we are supposed to place our trade with is 1.42. And remember, in the example I showed you, we placed that trade with a position size of 1 at first, and we're only risking $700. And the second one, we placed it with 2, and we're risking more than what we want to risk, which is the 1%. We're risking like 1,004. But this tool has now calculated everything for us in an instant. So what is left for us to do? To simply place the trade. And for that, you don't even need to go through the MetaTrader stress, bring it up, type your lot size. You don't need to do any of that. Just after you've placed, typed in your entry, your stop loss, your profit target, and everything into here, and you've specified how much you want to risk, just go to the trading tab and then click on trade, and then the tool, once you've enabled algo trading, okay, that's not what I've done. I've done it now. Once you've enabled algo trading, click on trade. Okay, in the tool also, let me quickly go to experts, and then its properties, and then here I'll allow algo trading. Click on it, close this, and then we'll just click on trade. Now it's asking for my confirmation. It's going to place a sell stop pending order with a lot size of 1.42 and account balance is 100,000. The risk is going to be $994. There's a reason for this, and I'm going to explain it to you. You see, this tool rounds down. When it's placing your trades, it rounds down the lot size. The reason why it does this is because, pay attention to the lot size we have here. Is 1.43. No, sorry, 1.42. So the reason we're risking $994 is because the tool is placing this trade with a lot size of 1.42. If we were to place this trade, which we can do, I did this from 1.42 to 1.43, which is the nearest number after that. You notice that when I click on trade in here and I click on trade, this tool is now going to place this trade, but the risk is going to go over our max risk per trade, which we want, which is 1% of this account capital, which is $1,000. So in this case, because we are trading with 1.43, you see the risk would be $1,001. So the tool, so that it's just helping us so that we don't go overboard, risking more than what we want to risk, it's rounding down. And there's a setting inside the tools settings tool where you can decide if you want it to round down or if you just want it to place the trade, even if it's with slight increase in what you want to risk on the trade. Okay, so again, moving on, I'll just go back and leave the tool to do what it does best, which in this case is we want to place the trade with a risk of $1,000. So it's going to be like this. I'm going to click on trading, click on trade, and it's asking for confirmation. This is my entry, this is the margin we are using, this is everything. I'm just going to place the trade and go like this. Okay, now it has just placed the trade with just a click of the button, and you see this trade has been placed. This is the stop loss, this is our take profit, and it's done all of the hard work for us. It has done all of the hard work for us. So this is how easy you doing your risk management can be, because most traders don't even know that tools like this are available for free. This tool is 100% free, and they make regular updates to it. Just download it, and you wouldn't need to worry about risk management any other time again. Doing it on your phone or using an app, or you wouldn't need to do any of that. You just install this tool, know when you're going to enter the trade, where you're going to enter it, where your stop loss is going to be, where your profit target is going to be, and then type them in, specify what you want to be risking, then click on trading and place the trade. That's it. It's as simple as that. So this pretty much brings us to the end of this week's edition of the class. I sincerely hope you got as much value in the class as I wholeheartedly gave you, hoping that you're going to improve your trading performance with these tips and tricks that we lend to you guys. Okay, so before we wrap up the class, I would like to use this opportunity as always to invite you guys to test out our suite of bots, which are expert advisors or trading robots, as other traders like to call them, which are designed to identify low risk, high probability trading opportunities on your behalf when you're out and about, or just having a good time with your family. It's going to be like a personal assistant who never takes leaves or breaks or any of that. Is going to be looking for low risk, high probability trading opportunities for you, place those trades with proper risk management when you follow our recommendations and all of that. So if you want to start earning while you're learning how to trade manually and all of that, if you want to diversify your portfolio, please reach out to us on any other of our social handles or drop a comment or question in the comment section. I will be more than happy to assist you, walk you through how to set everything up step by step. In the meantime, once again, I sincerely thank you for taking time out of your busy schedule to attend these classes and for being as interactive and attentive as you've always been. I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers.